whoever tells you that you need chunks and chunks of money to start your investment is lying to you. No, you can start investing with... Hi guys, welcome back to my channel. It's really exciting to have you here today. My name is Carina, darling. I'm a wellness coach. In 2022, we will be diving into the very important topic of financial wellness. I believe that holistically, we have to be well and we have to focus on every aspect of our lives. So this year, my focus will really be on managing money and growing wealth. So I want everyone to be so excited and subscribe, share this link with all your friends, because I want we women to grow in this area of financial wellness. So the more women that are empowered with money and the more women who see investment opportunities as something that can enhance their life, the better this world will be. In going into the topic today, which is on financial wellness and more especially why you should not put all your money in the bank. That's the word on the street, guys. That's what I've heard. So I want to share it with everybody, and I will be exploring reasons why this is important, that we don't put all our money in the bank, and how we can actually diversify our money, and also the type of money that you should keep in the bank. You may ask me, but Carina, what can I do? How can I ensure that my money is giving me more? I will share a lot more about that in this video, and I will share with you what happens in the UK, because I'm based in the UK. I do acknowledge that I have US subscribers and viewers, but I believe that in the UK we don't really share, and so that's why my emphasis today will be in relevance to what happens in the UK. Some of you might remember the financial crisis in 2008, and during that time a lot of banks suffered, a lot of banks went out of business, and more importantly, individuals really suffered. In the UK, since 2009, every financial institution, including the bank, is now regulated by the Prudential Regulation Authority, and these are the regulators. So the good news of this is that you don't have to live in the UK for this to apply to you. You can live anywhere in the world. That bank where you bank with is regulated by the Prudential Regulation Authority. The second good news you would love to know is each account that an individual has in a bank is protected to the sum of £85,000. So let's say, for example, you have an account with HSBC, and you have another account with Barclays, and you have another account with Santander. Each account you have with these various banks are protected to a sum of £85,000. So if that bank was to go bust, for example, the Prudential Regulation Authority protects your money up to the sum of £85,000. So that's good news in the UK, because this is not the case in America and other parts of the world. And so the question is, what then happens to the remainder of the amount if the banks are only protected up until £85,000? So perhaps the advice would be open a few other bank accounts if you want to hedge your risk, or you could do something else, and these are the options I'm going to put forward to you today. Have you ever asked yourself, does the bank have to retain all of my money? So let me take, for example, you put in £1,000, £1,000 into the bank. Does the bank have to have my £1,000 available? This is a very interesting one, and I really enjoy doing research on this. And the answer is no. So if you give the bank £1,000 or $1,000, they don't have to have your hard cash $1,000 or £1,000 available. And this applies in a lot of different parts of the world. In the US, definitely the answer is no, the bank does not have to. Most countries in the world, the answer is no, the bank does not have to have your hard cash £1,000 in the bank account. And it's because of something called fractional reserve banking. It's basically, in a nutshell, no, the bank doesn't have to keep your money. The balance of your money is used for investments. You may be asking, what type of investments, Carina? A lot of these investments are investments that would enhance the economy. In the US, the banks are required to keep 10% of the money you have deposited. So let's say, for instance, you deposit $1,000. The bank is only required to keep $100, okay? And the other 90% of your money has been used for various things. And today's video, guys, really, I want us to think about how can we become the bank? How can we look after our money the way the bank deals with our money? So yes, the bank use all of our money, my money, your parents' money, your boyfriend's money, husband's money, all of our money. The bank uses it to invest. And what type of investments am I talking about? It could be big infrastructure investments that are to do with governmental infrastructures and governmental entities and bodies, or private companies. It could also be in the form of loans. Remember, if you have a mortgage, you know that you had to put down either a 10% deposit or a 15% deposit, depending on what you're buying. If it's a buy-to-let, you're putting down 25% deposit minimum. Yes, those are loans offered to you by the bank. So I've shared the first point with you. The first point of why I think you should not put all your money in the bank is first because of what you're getting back. It's nothing compared to what the bank is loaning your money for. So why give them all your money for them to pay you peanuts and then use the rest of your money to make more money for themselves? Another reason which actually affects everybody, absolutely every human being, is inflation. Inflation hit us really hard last year. I believe inflation was at 5% or even above 5% last year. The Bank of England announced that inflation was so high, and that's why interest rates had to go up. Interest rate went up by 0.25% last year. A lot of people who had mortgages which were not fixed term mortgages, so variable mortgages, their interest rate had to go up. And the reason why interest rate goes up is due to inflation. Inflation affects all of us. So for example, let's say I have £1,000 in the bank today, and I decide that I want my £1,000 to buy me a Gucci handbag. I want to buy myself some goodies, maybe even go on holiday. And I have that idea that my £1,000 is going to be able to do this much for me by a certain time in the future. But guys, due to inflation, that's not the case. Your £1,000 will not be able to buy you all of those things you've listed out. So let's say 3 things you want your £1,000 to buy you. 1 is a holiday, 2 is a Gucci bag, and 3 is jewelry. And you realize that, oh my goodness, my £1,000 in the bank is now not able to get me these 3 items. I now need, for example, 1,500 or 1,250 to get me those 3 items. Why is that the case? Is because the value of the money you have in your bank account, which is not physical money, is virtual money, in reality cannot buy you the same thing as your physical money will be able to buy you. So let's say you are very comfortable leaving your money in the bank because you feel it's safer. I'm not taking any risk. When I turn on my mobile banking, I can see my money sitting there. But actually, your money is no longer worth in real value the same thing as what you were hoping to use that money for when you originally put it in. And that is inflation in a nutshell. So guys, today I just want to share with you what you can do with your money. So you may be asking me and saying, Carina, how can I make my money work for me? First is about changing your mindset. I would say change the way you think. How can you become the bank? What does the bank do that we don't do or I don't do? You have to ask yourself those questions. One, the bank knows where all their money is. Wherever their money is in a given day or a given second, the bank knows. So they're doing their audits, they're checking that all the money is where it should be and the money is doing what it's supposed to be doing for you. We're going to talk a bit more on budgeting, and I think that's one of the ways that we can become the bank. We need to have our own budgeting tools. We have to be checking regularly what our money is doing for us. We have direct debits that we're not using. Why do we still have those direct debits? Cancel it. Are we paying for things we shouldn't be paying for? Are you auditing your outgoings against your incomings? Are you balancing out your accounts to be sure that you have the money that you're supposed to have? And of course, I understand that some people have debts and some people are repaying some of those debts, and that's absolutely good, but that's even the more reason why having a budgeting tool that works for us would be beneficial. Another thing I think is quite important is to grow in your knowledge of how finance works. Don't look at it as something that is daunting. Actually look at it as something that can enhance your future. If you don't know how your money is working, how would you be able to enhance your life? So I would say recommendation, read, learn to understand finance. One of the books I recommend, and that's the book book that really changed my mindset about money is Rich Dad Poor Dad. For me, that book literally changed my life. You remember I used the phrase, you need to become the bank. Literally, you need to become the bank. And one of the ways that you need to become the bank is to actually beat the bank at their game. How can you do that, you may say? One of the ways you can beat the bank at their game is use the bank for what they're for. So for me, I use the bank for my emergency funds. An emergency fund is the specific amount of money that you will use in an emergency. And what are emergencies, you may be asking? Emergencies are things that happen suddenly and your finances is required. It's like the things that come up that are unplanned. Basically, is the name emergency. You need to do something. God forbid something has come up and you need to travel immediately and go and see a loved one. Maybe a loved one is ill and you need to quickly go and see them. That's an emergency. You can go in, tap into that, take some of that money. Another emergency that I believe is if, for example, your boiler breaks down. That's an emergency. You may actually want to put a specific amount away for renovation and repairs in your house rather than leave it in your emergency fund. How do you calculate an emergency fund? Rough estimate. I'm not telling you what to do with your money. This is just a guide. Roughly 3 months to 6 months worth of money can be your emergency fund. So you calculate how much do you need, not barely to pay your bills, but to live, to keep going, maybe not to go on holidays and go shopping, but the bare necessities that you need, like your food, your shelter. How much do you need of your salary do you need to put towards that every month? So calculate whatever that is and keep that particular amount away to be used for that specific need. And then very finally, invest your money. Investment is the only way that your money can grow for you. And 90% of the richest people in the world, or probably more than that, how did they make their money? They made it through investments. They invest and reinvest and reinvest. And you want that for yourself. So wherever the banks are investing, you're investing there as well. They're investing in the stock market. You invest in the stock market. But I'm not asking you to just go and start investing when you have no idea of how to even start investing. What I did during investment was I literally opened a dummy account, a trading account by dummy account. And usually with these trading platforms, they give you dummy accounts and they put X amount of money, probably 100,000 or sometimes 10,000, that you can play with. And so I used that to play. I used my dummy account until I felt more and more comfortable to invest real money. And whoever tells you that you need chunks and chunks of money to start your investment is lying to you. No, you can start investing with £50. But what I would suggest, if you're somebody who is afraid of risk, and yes, you should be at the very beginning stages, use them to invest, grow, learn. You're going to fall. I fell a lot. I lost a lot of money in my dummy account until I felt a bit more comfortable and I started investing gradually in my normal account where I paid in money into, and then gradually started to get the game. And now I feel more and more confident. I can invest more because I've done a lot more education in financial awareness and I continue to educate myself. And so I've moved on from even stock market. I've also gone into ETFs. I will explain these phrases as we carry on this journey. So these are options that are open to you, and I will explore each and every one of these topics as you let me know in the comment section below. That's where I get my hint of the topics that you want me to share. On that very good note, I will have to be saying goodbye to you. Thank you for tuning in today. I've really enjoyed sharing this topic with you, and I look forward to seeing you again in my next video. Goodbye.